Okay, folks, we're going to get started here with this lunch panel. So we've got 3 folks with a lot of experience in the policy environment. And we're going to talk on this panel about policy innovations and impediments to expanding ownership. So maybe we could get started here if you guys could just give a minute intro on yourselves and the work that you're doing. And Madhavan, I'm going to start with you.
Hello. I hope everybody's enjoying their lunch while we're up here entertaining the masses. I'm Madeleine Martinaire. I am Managing Director of Zebras Unite Co-op. So Zebras Unite is an ecosystem support organization for entrepreneurs of a different stripe. So we are really focused on how might we more effectively and equitably mobilize capital, culture, and community for businesses that are building things that are better for the world. I'm a facilitator, a strategist. I worked coming in from a grassroots activism background and also a technology background. And increasingly, we're finding ourselves in policy conversations. So excited to be here.
Awesome. Jack?
Good afternoon, everybody. I'm Jack Moriarty. I'm the Executive Director of the Lafayette Square Foundation. We're a 501c3 affiliate of Lafayette Square, which is an impact investing platform. My background, I previously founded a group called Ownership America, which is premised on the idea that accelerating the growth of employee ownership is critical, and we need policy solutions to help make that happen. So I'll talk a little bit about some of that work that remains ongoing. We're keeping Ownership America as an initiative of the foundation. So excited to continue that work and build around it, around the idea of how do you mobilize private capital to advance economic security for workers and communities.
And my name is Anthony Cimino. I am head of policy at CARTA. CARTA is an equity management platform that in many ways supports the innovation infrastructure. Basically, we have 36,000 companies on our platform for whom we run their cap table services, provide valuation services, and around 6,000 funds that invest in those companies. And we've built out a policy team largely to connect that innovation ecosystem with the policy ecosystem, both helping a lot of our customers and stakeholders understand and navigate policy. We're also taking a lot of those friction points and opportunities, bringing them to policymakers to ultimately make more of those fixes that can broaden the ownership economy.
Cool. So the way I want to structure this lunch panel is to talk through kind of policy innovations and impediments that are kind of in the ecosystem today I think we should focus mostly on innovations, but we can talk a little bit about the impediments around expanding ownership as laborers, expanding ownership as investors, and expanding ownership as community members. And so, Jack, I wanted to start with you because you've got so much experience in this recent legislation that is, I think it hasn't been passed. It's
been introduced. That's right.
And so maybe you could just walk us through the Employee Equity Investment Act. What is it trying to solve, and where is it today?
Sure. Well, I'll take a step back, and I think the employee ownership leaders in the room know that employee ownership is not a new idea. We've had ESOPs and worker co-ops for a long time, but it's been a stagnant field. Despite the growing energy and attention, we're actually losing more ESOPs every year than we're getting new formations. And so there's this real challenge of, well, we know the research is clear through Rutgers and NCEO and others that this is a powerful model for workers. It's a better model for company performance, communities, et cetera. Why don't we see more? And there are a lot of answers to that question, but one that we focused on with this legislation is really around financing barriers. And if you look at how most ESOP and worker cooperative transactions are financed, it looks a little bit different from a traditional private equity sale or certainly a strategic buyer, where typically sellers in those situations are getting a substantial amount of liquidity at closing, right? They're getting their cash, they're funding their retirement, whatever they're going to do next, and off they go. But with an employee ownership conversion, and this is a shared problem between an ESOP and a worker co-op, typically a lender will come in, say for just ballpark 25, 30% of the transaction, but there's this capital shortfall, and it's incumbent on the seller to take back a subordinated note and get paid out very gradually over time. And that's worked well for a relatively narrow segment of sellers that they don't want to exit right away, they're comfortable with a gradual repayment, or they just really believe in the idea of employee ownership and they're willing to take a concessionary structure, essentially. But most sellers, despite the potential intrinsic value of preserving their legacy and taking care of their employees, they want their cash up front. And for those sellers, employee ownership hasn't been a competitive option. So I want to be brief. We can come back to some of the mechanics and the detail. The animating premise of this Employee Equity Investment Act legislation is this capital gap is a policy problem to be solved. And we've used, using this legislation, the tools of federal credit enhancement to try to mobilize private capital sources to make it more interesting for investors to invest in strategies that are solving that liquidity problem and creating more employee-owned companies.
Great. So we'll get into the mechanics of it in a second, but I thought, Anthony, maybe you could talk a little bit about the work that you guys are doing around expanding employee ownership and just how you see the landscape today.
Yeah, it's near and dear to Carta, and we've started in many cases in that venture space with the goal of how do we expand ownership and how do we make that ownership meaningful by making it liquid. And we've seen this work in the venture model where in order to attract capital, you issue shares not only to investors, but of course to employees. Doing so gives a huge amount of long-term alignment and of course helps those employees gain access to that upside. I think to actually piggyback on something that Jack said, there is in many cases a capital gap in some of these spaces where when we move outside of venture, how do we start making more people aware of what can happen in more traditional businesses? And to be certain, there are different constraints from that venture high growth model, high scale model, but there's still an incredible opportunity where by empowering employees, we believe that they not only are more effectively able to attract and retain and engage that employee base, but that leads to better performance. And so what we're actually trying to experiment more with is how do we stop talking about this just solely in the context of virtue, where to your point, there might be a founder or an owner just saying, I'm interested in this. It seems interesting from a virtue perspective, but how do we start talking about it in the form of value, especially as a lot of these businesses are undergoing more transition? But that leads to education. So how do we talk about what this means for performance? And then how do we start talking about this, what this means for employees? Importantly, this is a conversation we've tried on a national basis, but we're also starting to experiment more on more regional basis in different sectors. And in many cases, especially on the policy front, what we're trying to experiment more with is how do we work with local governments, state governments, city governments to try and incentivize more equity ownership, whether that's through awareness, tax incentives, tax grants, and ultimately education, not only for that conversion, but the ongoing administration. And in particular, we've noticed like a state like Colorado has been a lot more forward-leaning on this. How do we build on their model there, but then take that into other areas where it might not be as obvious, but by doing so with incentives, you can start to bring this model into more and more of these geographies.
So maybe we could get into the Colorado model for a second, and you can just explain that, because I think many people in the room won't know it.
Yeah, no, and forgive me, I should have given a little bit more context. But so in Colorado, for instance, they have recently passed and actually expanded tax incentives and grants for the cost, a portion of the cost to convert from a traditional business to an employee-owned business. And they've expanded that from any number of different types of C Corps to things like LLCs. And what's important to them is not only that conversion, but how do you provide support for the ongoing administration of it? And the reason why that's important isn't so much that that founder or entrepreneur can have some of those costs subsidized, but it can incentivize not only confirming that that employee ownership model stays in place, but how do you start thinking about empowering and arming those employees to understand what ownership means and how do they maximize those gains? So they'll not only help defray some of those costs on the front end for qualified entities, but on an ongoing basis as well. And so Carta, which again is expanding into more and more of these traditional business models, is partnering with them to not only think about how do we expand access to this, but how do we make the market more aware of it? Because in many cases, there's a lack of awareness to not only that this exists, but how do you proceed and actually make it a reality for your business and for your employees?
Great. And then before we go beyond employees, I think Jack, maybe it's useful to go into a little bit of depth into the mechanics on this, on the act and how it's going to function.
Absolutely. So again, sort of zooming out high level, there's really two problems that we approach this legislative process to solve. The first, which I mentioned, is this seller liquidity problem or the absence thereof in an employee ownership conversion. Right now, we need to reduce the opportunity cost for sellers that may be interested in employee ownership, but they aren't willing to take back a subordinated, long-term note. And that's fine. Let's find ways to deal with that problem. The flip side of that is if you're an LP and you are not necessarily an impact investor, you're looking at, let's say, an employee ownership investment strategy versus a traditional buyout strategy. You are going to say, well, I'm basically in an employee ownership strategy taking equity-like risk for a capped return, right? And that's by design. By design, this is a model where the majority of the economic value, the ownership of the firm, is being transferred to employees. That's why we're supporting it. That's why we want it to scale. And so, because it's inherently dilutive, how can we address that it's not as compelling a return profile? Well, there's tools, it turns out, in the federal government already to deal with that. And so what we've done with the bill is to look at the Small Business Administration, an existing program called the Small Business Investment Company Program. It's been around since the 1950s. It's been very effective and popular. What it does is it enables private investment funds to show up, raise some private capital, show up to SBA, and if they get licensed, to get a multiple of their privately raised capital in the form of low-cost, long-term SBA debt. And what's great about this program is, first, what does that do for the fund? It gives them more capital to deploy, but because the leverage is concessionary price, it's federally guaranteed leverage. SBA packages those loans up and they sell them. It's actually a loan guarantee program. But it enhances, subsidizes the return profile to those investors. And in return for all that, investors, those funds have to go invest in small businesses. What we've done is to say, that's been a proven model. It's worked well. It operates at what's called zero subsidy cost to the taxpayer, which means it doesn't cost big appropriations, which is why it's popular, among other things. And so that's an effective model. We've stood up essentially an adjacent credit facility of $5 billion, which again isn't an appropriation. It's just, it is a credit authorization of debt that would be available to specialized investment funds that are investing in ESOPs and worker cooperatives. The idea being, if you can get your return profile subsidized using an employee ownership strategy, you'll have an easier time raising capital, and you'll be able to go into these transactions with sellers and say, we're going to give you liquidity on par with your other options that may not be employee ownership. And so that's how we hope to deal with these problems. I should add that the bill is both bipartisan and bicameral. So in the Senate, it's being led by Senator Chris Van Hollen out of Maryland, and also Senator Marco Rubio out of Florida, and a bicameral group in the House as well. So it's sort of the conversation we had in the morning around, well, can government really deal with these problems? Well, I would say I'm cautiously optimistic, because look, we've got a bipartisan, a very politically diverse sponsor group that's saying, yeah, we support employee ownership. We want to move capital into this market. We want to address this market failure, and we want to see more employee-owned companies.
Cool. And so the last piece of this puzzle is, if I can kind of sum up briefly, a portion of this is education to the employees themselves. A portion of it is unlocking or creating new financial incentives for founders to actually sell. And then one other last problem I want to highlight before we move on is this concept of fair market value. One of the challenges around the space is that there isn't this definition of fair market value in the employee ownership space. There's now, I think you mentioned yesterday, the Department of Labor is creating a new definition of fair market value. Can you just explain the nuance there really quickly?
Sure, quickly, and this is a little bit outside my lane, but it's a really important development for the employee ownership field, which is, as you alluded to, in an ESOP transaction, a trustee is always appointed, and the number one job of the trustee as the transaction is being consummated is, how do I make sure that I'm not paying above fair market value and giving what's called adequate consideration to the purchase price? And one of the regulatory challenges in the ESOP field has been that definition of, well, what is actually the process by which a trustee would determine fair market value has never been promulgated. And so what Congress did in 2022, last year, is to reiterate in statute a directive to the Labor Department to promulgate these regulations, and the Labor Department has publicly committed to doing so by the end of this year, proposing a rule that would define that in more detail. The hope being, if you had a high quality definition that was, provided certainty, it would reduce some of the regulatory risk, both for sellers and for trustees.
Makes sense. And so this goes back to Melissa's comment on one of the earlier panels and what John said around why would you actually set up a token. One of the challenges around employee ownership is that you don't have the ability to pay significantly above cost through synergy. Whereas with a token, you can actually have liquidity that could be priced in the market, and you have that transferability. And there's nuance there because theoretically, you shouldn't have a security that can do that, but the way these tokens actually trade, they do. So Madeline, I want to get to you, but I first want to queue up kind of the gap, because it's not just about employees, it's also about other stakeholders that create value. And Anthony, you wrote a really good article on SEC 701 and the challenges around that and why it's hard to actually expand ownership to consultants and others. Can you just touch on that briefly? And then I think it'd be useful, Madeline, to hear a case study of what you did with zebras to try to incentivize the community.
So hopefully folks were here for the last panel, which was, I thought, incredibly informative, especially as you think about platforms and non-traditional or gig workers. But when we often reference Rule 701, that is the avenue through which you will issue equity largely to your employee base, and that tends to be a very traditional employee base. What we've seen, however, as discussed in the last panel, is that non-traditional workforce, consultants, gig workers, and advisors is growing and growing. And Rule 701, and in many cases, the regulatory structure just in general, hasn't necessarily kept pace with that market change. And so the SEC in the past has previewed that they do want to revisit 701, but that's all they've done is preview that. And so what we're trying to figure out is how do we get clarity on how more companies and more entities can issue equity to those, in some cases, advisors, which is getting more and more clear based on practice studies, but in many cases, those gig workers and those users that we'd want to issue equity to and have them participate in the upside of these types of platforms. We've not seen as much movement on this yet. It's something that we actively continue to work towards legislatively. Though that said, as we've discussed here, there are partisan politics at play here, especially around what this might mean for that workforce. And is this an avenue through which you're ultimately trying to underpay or wage replace in exchange for equity? And in our opinion, that's a false trade-off, but you still have to structure this in a way that makes it clear and helps facilitate more of that equity for a lot of those gig workers to enable them to participate in the upside.
Well, so I think that leads into, Madeline, some of the work that you've done around zebras. I think it'd be useful as a case study to hear about how you've tried to give, well, I don't want to paraphrase. I think it's ownership. It might be governance. But in your own words, what you've tried to do with the community that you've built, what some of the challenges were, and why we need to be thinking about this beyond the traditional employee definition.
Yeah, so a couple of things. I mean, I feel we got into the weeds around employee ownership very, very early. I will say from a Zebra's perspective, we're actually quite agnostic. So like our interest is in the values and the value flow in this, right? So whether it is best for you to be suited in an employee ownership model, whether you can do participatory culture and governance inside of a traditional organization in a C Corp or an LLC, that can be done. You can do it with a token. There is models that are at play, but I don't feel like even in these conversations that we're actually having the conversation around the broader definitions of value and how we are doing that. And I will also say that the accent may fool you, but my bend is much to a global perspective. So I'm thinking, we'll talk about some of the things that are happening in Japan, but we're focusing on a US context. I appreciate that we're sitting here in New York. And there are models that are at play far beyond what is happening here. And there's models that have been working around employee ownership that actually have been alive and well happening in the United States. We don't talk about them in these rooms. Right? So from a Zebras Unite perspective, I think we made a choice. So Zebras Unite was a movement first, kind of an accidental movement. We wrote, our four founders wrote a Medium post called Zebras Fix What Unicorns Break. And this was coming out of a lot of the frothing in Silicon Valley around that the unicorn model was the picturesque model of building a company. And for 99% of the entrepreneurs, particularly of which that were building businesses that were better for the world, leveraging technology, for women that were building these businesses, for people of color, good luck getting access to the capital that you need to be able to build that and the support structures. I wish I could say that it's changed, and it hasn't. And so we ended up building a nonprofit first, because that's what you do. You build the 501c3 and work within that legacy model. And over time, as we were working with our community and stakeholders, one of the things that we recognized was that one of our core values is mutualism. If we were actually going to practice that, we needed a structure that was going to support that. So we made the decision to create a cooperative structure, structured in the US as an LCA, which has worked well to give us a backbone to be able to do that with our community, by entrepreneurs, for entrepreneurs. And I really resonate with a lot of what's been said in this room, and some of these, through the through line of some of these conversations around the practicalities of building a business. But just because you have a cooperative structure, just because you are doing employee ownership, doesn't necessarily mean that it is a viable business or an investable business. So the foundations of what it means is something that still is applicable, which is why we spend a lot of time in education, both for entrepreneurs and increasingly in the capital markets, around what it means to invest in these organizations. So there's a lot of learnings, I think, when you talk about, from a Zebras Unite perspective, what our evolution has been. I will say it's been crunchy. It's been bumpy, right? We've learned a lot, and we're trying to build a global community. We have 200 members across 23 countries. And we're domiciling that in the US. And that's not going to scale for us forever. We have to be looking at some of these alternative models. We have to be looking at some of these token economics to figure out a way that we can mobilize that shared governance and ownership with our global community.
Cool. Awesome. Thank you for that. I kind of want to get into the international point with you, but I want to table that for a second. I think we can switch gears now. And Anthony, when you guys think about the work that you do, I think you focus on thinking about increasing ownership through wages, through labor, through being an employee, and the other is through being an investor. Can you talk a little bit about the policy environment around that and the stuff that you're focusing on right now?
Of course. We think about ownership, to your point, not just through the employee prism, but how do we expand it more broadly? And in many cases, ownership, especially in private markets, is very exclusive. And why this matters? Well, more companies are staying private, and those that do go public do so later in their life cycle. And oftentimes that's after they've had their growth curve and are moving into more of a stable, steady state there. And so if you are precluding investors from investing in those companies, that's going to be an issue in which you're not letting them take advantage of those gains and not letting them take advantage of that diversification that the private markets can provide. But that's the way the US structure is set up. Through the accredited investor rule, which is largely determining who can invest in these private markets and alternative assets through wealth and income, it basically sets up a system in which wealthy investors can invest in these growth assets and diversify their portfolio. Those without those wealth thresholds, income and assets, ultimately are excluded. That's even more problematic when you think about these being national standards and what that does on a geographical basis. So Carta is a San Francisco-based company. We operate globally, but San Francisco-based companies, the per capita income is around $126,000 in San Francisco. In Atlanta, it's around $70,000. It's a national accredited investor standard. There are going to be more accredited investors in places like San Francisco than Atlanta. Well, that's unfortunate because those investors miss out. But importantly, we've all talked about the gap for many businesses is capital, whether that's capital coming from credit facilities, capital coming from venture or investors. And so when the SEC's looked at, not necessarily accredited investors, but small business capital formation, they've acknowledged that the typical seed or Series A round in their lead investor, the geographical distance is 100 miles. So capital is definitely more mobile, but proximity still matters. And so when we think about excluding investors, we not only worry about that from the investor perspective and what their ownership might look like, but the ability of more businesses to be seeded in more places. And oftentimes that can not only lead to greater geographical diversity, but talking about women founders, people of color, and creating more opportunities outside of those traditional markets of places like San Francisco and New York. And so that's why we focus not only from an ownership perspective, but what that does from a capital formation and an innovation perspective as well.
So if you were Gary Gensler, what would you do?
Well, he stopped taking my advice a long time ago, but No, so what we think about is not ripping out accredited investor standards, root and branch. By no means are we saying anybody should have access to private markets and ultimately invest whatever they want. But we do think that there should be more on-ramps beyond wealth and income to private markets and alternative assets. And although the SEC has expanded some of those on-ramps, they're still very exclusionary, where you can qualify through various series, like Series 7, Series 62, and different certifications, almost all of which you have to be sponsored by a financial institution. So even though you can qualify outside of wealth and income, you probably have to work for a major financial firm. What we want to do is create on-ramps where there's sophistication tests or expertise, where any person, if they're willing to put the time, effort into it, that shows that they might be able to make this a virtue for them by investing in private markets, has that access and increases those on-ramps.
Makes sense. And for those in the room that aren't in the crypto or blockchain communities, what's happened as a result of this is that you essentially have the entire move to these concepts of governance tokens, because if it's a security token, it falls under the SEC's regulation. And effectively, this is where a lot of these projects that started out and were able to raise a lot of money ended up getting sued by the SEC, given that they were treated as securities. And so this kind of goes back to who is able to invest in these new innovative technologies, and without a proper definition or without on-ramps to bringing people into the investment ecosystem, we're always going to have a large portion of our society, at least in the US, as we're talking about right now, but also around the world, that doesn't have access to capital assets, which again, as we've seen throughout the day, is a big challenge for decreasing inequality. So before I open it up to the audience, what should we know about the international context?
That's a
whatever
hell
you
of a
want to
question.
talk about. Yeah. Well, we talked a little bit about Japan. We talked a little bit about Mexico. We very much want this event to be a global event. And so what are you seeing out there that excites you?
I mean, I think there's a lot of interesting things that are happening. And this is part of, I appreciate there's a bunch of, we're in US context. I also know there's a lot of Americans in this room that do not live in the US anymore. But I think one of the things that we've recognized at Zebras is that there's no one stripe to how to do this right. And depending on which culture and context you are coming from, what an ownership economy looks like is going to look a little bit different. And so I think there's a lot of, when we talk about education, right, we still have a tendency to focus on the education in the particular jurisdiction that we're in. It's around particular policies, particular legislation, which is helpful if you were trying to get access to capital in that particular place. But if we're not taking a more systemic view and looking at what's happening across the board, our ability to innovate beyond what we know to be true, to beyond those systems, is actually extraordinarily limited. And I think there's also challenges to look at. So we've done, I mentioned that we work with 23 different countries. We have chapter leads across those 23 countries that are doing local work, and local work with entrepreneurs, local work with investors, and increasingly local work with policy. So our Japanese chapter leads have been working for the last several years with the Ministry of Economy around writing in Zebras into the new economic policy, which has been an enormous effort of they're building their new economic strategy that is focused on incentivizing and revitalizing funding towards small, medium-sized businesses, focused on rural, we talked about, and regional investing, which is great in theory, right? It's fantastic to see more of these coalition building, to see these kind of feedback loops between the communities that are there to support the entrepreneurs with the capital markets and the policy. And it looks really good on paper from a policy perspective. But where are we now? Now they have an opportunity. They're going to have to completely re-educate capital markets that have been, from the beginning, from the last bust in 1992, have been told to be extraordinarily conservative around their investment. And so they're saying now we have to go, and now we have to be more innovative. We have to take more risks as a market. And they have a choice right now from an education perspective. Option one is going into the existing capital markets and retraining a generation of financial institutions who were told to be conservative. Or option two is go into the universities, is actually start a lot sooner, sooner in and with younger folks, which is more likely going to get them the outcomes that they want in a longer time frame. All right. So that's one example of it where we love to see that kind of innovation. We love to see that cooperation and coalition building. And I know you wanted to talk about the innovations and not the risks, and I feel challenged by some of this because there's this implementation and education gap that kind of still remains to be seen, right? And any of these policies is, well, then what comes next? Whose burden is it to actually do that education? And here we are talking about the great bipartisan work that's happening. And as individuals, institutions, most of our organizations are the ones that are putting in the effort and energy into that education.
Can I add, Martin, a quick, exciting international update? So I was in Slovenia last week, of all places, which is a beautiful country. I recommend it. And turns out none of the EU member states have an ESOP-like structure. So Europe has the same silver tsunami problem that we do here in the US. What they don't have is a buyout structure, an employee buyout mechanism that is legally codified. And to make it even more complicated, most of the EU member states don't have common law, so they don't have trust law. So ESOP is a trust. They don't have trust. So what the Institute for Economic Democracy, based out of Ljubljana in Slovenia, has done is designed a European ESOP, essentially. And they unveiled and effectively introduced the law into Parliament last week, along with the tax incentives and some legal structures. There was a representation from the European Investment Bank there trying to really, we did this very slowly. We got the ESOP, and then years later we got the tax incentives for sellers, and then we got the S Corp, income tax shield, and then Main Street happened for development finance, and the EIA is hopefully next. They're trying to package it all in one, which is fantastic. And so just some really exciting models that are distinct. And what they've done is to say, hey, the ESOP has been more successful than anywhere else in terms of scale. We love what it's accomplishing. If we were to design it from scratch, we probably wouldn't tie it to retirement, probably wouldn't have it in pension law. So we're not going to do that. And we like how quickly the employee ownership trust model has been picked up in the UK, but it's just profit sharing. It doesn't have internal capital accounts that actually build equity appreciation. And so that's a flaw that we need to address. And so they've combined the best of both worlds into this model and introduced it. And so the hope is of course, they first have to get it passed nationally in Slovenia, but it could and I think should become a European template for employee ownership to deal with the same challenges that we are here.
And does it involve any co-determination or any governance rights, or is it purely economic?
It does involve some governance rights. So it does go a little bit farther than the ESOP because they've actually used, again, because they don't have trusts, it's a cooperative structure is the legal basis for it. And so there is some flexibility around, is it one share, one vote? Is it one member, one vote? But they've put those options on the table, which is, Europe is no stranger to co-determination and some of that. So it's a little bit more, it's culturally compatible.
Just for people in the room, co-determination, effectively what it means is in Northern European countries predominantly, but also to a certain extent in Spain and France, when a company gets to a certain size, the labor class or the laborers actually have a certain number of votes on the board, and that gets up to 50% of votes for companies, I think in Germany, about 500 employees. And so you actually have this, it's a very different capital structure that is embedded in the Constitution. So it blows my mind a little bit that there's not an ESOP structure, but it makes sense given common law. Cool. So I'm going to stop there because I'm sure there's questions from the audience. So are there any questions? Is everyone in a food coma?
Anthony, I'm really interested in what you said about accredited investors. I'm wondering, do you have any thoughts or have you seen any examples of where ownership forward companies have used crowdfunding regulations to sort of kickstart some of these outcomes?
We do see crowdfunding pretty consistently. And just for folks in the room, crowdfunding enabled by what's called regulation crowdfunding, Reg CF, allows you to solicit, your kind of average retail investor in certain contexts there. And so we're seeing that as an on-ramp. We don't see it as consistently as I think Congress initially intended, but that to us is signal that more needs to be done. And I think when we've worked on a congressional basis, there is bipartisan support to acknowledge the current accredited investor standard isn't actually the right standard, but changing it is very hard to do. And I will say, in policy, I always try and give everybody the benefit of the doubt. And when they're trying to create accredited investor standards, what they're trying to do is protect investors. I worry that they've gone too far, and in the effort to protect investors, they started precluding them. On Reg CF, that was definitely an area where they tried to pull more of these retail investors on. Where we get concerned is, does that lead to a bifurcation between, for lack of a better term, kind of that sophisticated institutional capital? And when they pass on investments, do those types of companies then move into those crowdfunding platforms? And then all of a sudden, you've got that bifurcation to where retail investors might be able to access that deal versus when we'd want them to be able to kind of follow on or pair with more institutional investors. But I think this is all signal of more needs to be done to not only create capital for companies to raise, but expand investor access there. So it's not a perfect answer to your question. I would imagine Reg CF stays where it is. What I get concerned about is the SEC might actually raise some of those financial thresholds for accredited before Congress can act to expand more of those on-ramps. And that's what we're actively working on right now with policymakers.
Others?
Any other questions?
No? Any final thoughts from you three? If we don't have other questions? Anything hopeful?
I feel like we talked about this earlier, because there's been a lot of consternation as to like what the role of government is and whether or not it can solve a problem, what that looks like. I would say, and as somebody who spent a lot of my life in policy, I am inherently an optimist. And we look at, of course, this is in a global context, but in the US context, this country has been through quite a bit. And we continue to kind of figure out ways to thrive, but that's because people show up and that's because people engage. And we're not always going to agree, but I do think when you look around this room, what's really actually exciting for me is people showed up and they've got thoughtful questions. And I actually think that we're at a pretty important point in this country's life cycle where the regulatory regime hasn't kept pace. And it's in many cases being really used by incumbents to create barriers to entry for a lot of this. And now technology's enabled a lot of that capture even more effectively. And so we've all talked about in many cases, it's people in this room showing up and we need more of us to do it. But if we're not at the table, those decisions get made in even worse ways. And so I don't know what the final thought is, except to say I'm inherently an optimist. I believe that we can actually get to the right policy aims, perhaps not immediately, but that's done by people showing up. And so I'm really appreciative not only to be here today, but to see everybody else here and hope that this continues.
Anything else?
Couldn't have said it better myself.
Okay, awesome. Well, thank you all. We are going to take a 10-minute break, 15-minute break. Let you guys hang out for a minute, and then we'll be back here at 1:40. Okay, awesome. Thanks again.